Well, hey everybody, it's Tim Kelly, and welcome to another thrilling Homebuyer Finance 101. We are live on YouTube, and if you are watching this live, please join in the conversation. This is supposed to be as interactive as we can. If you're watching the recording in the future, go ahead and just drop questions. We'll monitor this video and be sure to respond to any questions, comments that do appear. But I am here in Reston, Virginia, right outside of Washington, D.C., and very excited to be here with you today. We are in the second half of 2026, and this class, this live stream, is all about preparing yourself to purchase a home before the end of the year. Now, this is specifically for first-time home buyers, so it's kind of like a high-level overview of everything. So we're going to jump into it. When it's all said and done, these usually run about an hour long, hour to 90 minutes. So it's going to be pretty quick, but again, I'll do my best to kind of monitor the comments. If anything comes up, feel free to put a Q so I know there's a question, and I'll be sure to address those as we go through today's live stream. But we're going to be talking about Homebuyer Finance 101. We'll take a quick pause here for compliance, and then we're just going to jump into it. So for those of you that don't know, my name is Tim Kelly. I am a loan officer right outside of Washington, D.C. I have been in the mortgage industry for almost 20 years. I started doing these live streams recently. Before in the past, I used to do a first-time homebuyer class in person every single month at an office in Falls Church, and just transitioned to doing these online. So if you're watching the recording, we'll have everything in chapters, so you can jump through different sections in the timeline below, so be sure to check that out. If you are watching live, again, hopefully you stick with me here. But before I kind of get into anything, I just want to kind of set the stage on how this works, how getting a mortgage works, because this is for first-time homebuyers, so you've never done this before. But I have often found that many people that I'm talking to and working with purchasing their first home have purchased multiple cars. So they're more familiar with that process when compared to purchasing a home. So I want to kind of put them in the driver's seat, so to speak, so they have a better understanding of how getting a mortgage is pretty similar to getting a car. So with that being said, there are two markets. There's a secondary mortgage market and the primary mortgage market. When you are going through this process of purchasing a home, you're going to be dealing in the primary mortgage market. That's where you're going to find mortgage bankers, mortgage brokers, credit unions, and banks. When you are on my side of the desk, we also deal with the primary mortgage market where we work, and also the secondary mortgage market. And in terms of the auto industry, think about the secondary mortgage market like the auto manufacturers. Like you're going to have Toyota, Honda, Mercedes. So that is like the secondary mortgage market. Basically, they are building the products, Fannie Mae, Freddie Mac, and Ginnie Mae. They're building the vehicles that's going to get you into your home. And in the primary mortgage market, that's where you have your dealerships. Like here in Northern Virginia, we've got Coons, Oarsman, Ted Britt, and a lot of big dealerships in the area. But they're not making the cars there at the dealership. They're taking the cars from the manufacturer. When you're dealing with your mortgage banker, your mortgage broker, your credit union, or your bank, they're not building the mortgage products that you're using. They're not building the vehicles that you're using to purchase your home. They're essentially a dealership going from the manufacturers, Fannie, Freddie, and Ginnie Mae, and selling the products for them. So if you were to go to a car dealership and you wanted to purchase a Toyota Camry, you can't go to the factory and drive the Camry off the factory line. You've got to go to the local dealership and buy it from them. And it doesn't matter what dealership you go to, it's essentially the same vehicle, right? The same Toyota Camry. It's got the steering wheel, the seats, the windows, the tires, all of it. It's basically the same car no matter where you go. And a mortgage is pretty much the same way. Just like a car, like a vehicle, it's like essentially at the end of the day a commodity. Now the difference is the experience you get and the cost, just like it would be when you're purchasing a car. You can buy that same car pretty much anywhere, It's just going to be a different experience and a different cost. Mortgages are the same way. So if I was going to give you a conventional loan, it would be the same conventional loan. Most likely, if you were to go to any other bank or lender and speak with them, the difference is the rate and terms that you're going to get through us versus them, and also the service, right? Your experience with getting that mortgage. So there's a lot of similarities to purchasing a car to getting a mortgage. And just like when you are purchasing a car, you need to shop around, and we'll get all into that here in a moment. But before you go and start this process, there's a couple things you need to do. Okay, just like if you were to go buy a car, you're not going to just turn 16 years old and go buy a car. No, you've got to have your learner's permit. You got to learn to drive. You've got to have enough money to be able to afford the car. Perhaps have a job to afford the car payments, or enough cash saved to purchase it outright. You have to have insurance costs. So there's a lot more to the process. And there certainly is a lot more to the process when purchasing, which is often your largest asset, your home, and coupling that with what is going to be your biggest liability, your mortgage. So the first thing you want to do is you want to establish a household budget. There's a couple ways that you can do that. More on that in the next slide. You also want to check your credit. You're entitled to a free credit report. We'll get more into that here as well. You probably want to go ahead and do that before you have the lender pull your credit, just so you can check and have an awareness about what's on there. You want to start saving, whether you use some first-time homebuyer programs that offer low down payment or no down payment options. Owning a house has costs, and there are closing costs when you do purchase a home. So you want to be prepared for those. So start saving as early as possible. And then you want to find your lender. Hopefully they're local. There's some benefits to that we'll get into, and determine your location. And then find your realtor and be ready for changes and potentially some pitfalls. So the more prepared you are for dealing with any of those hurdles, the better. So when it comes to the budget, there are some great budget worksheets that are available online. This one that you see up on the screen is a 3-pager from Freddie Mac. This is one of their older versions, but if you just go on to Google or pretty much any site and just type in budget worksheet, you can go and look specifically for this one from Freddie Mac. The Consumer Financial Protection Bureau, CFPB, has a great budget worksheet as well. But you want to sit down and figure out that budget. You want to kind of do it a couple different ways. And it's really important you do this before you even have a conversation with a lender, have a conversation with a real estate agent, or even a conversation with your friends and family. You need to know your numbers. You need to have a budget established where you are today, and then have an idea of what your budget's going to look like in the future, right? If you are, a single individual looking to purchase this home and you are in the beginning of your career, is your income going to go up? Is it going to continue to rise? If you are a married couple or a couple and you're looking to start a family down the road or start a business down the road, is your income going to decrease, or is it going to stay stagnant? Are you going to have additional costs such as childcare expenses or travel, things like that? You need to have a couple different versions of your budget: your version today and your version in the future. Now, you don't have to, life happens. Things don't go always according to plan, so you can be prepared for those changes, but at least have some sort of vision and some sort of idea of what you think your budget's going to look like in the future. Because unlike renting a home, when you own the home, that's not going to be an easy, thing to get rid of, right? You have to go through the process of selling the house or going out and finding a tenant to occupy the property. So you're not easily to maneuver as quickly as you would be if you were in a rental or living at home with family. So have kind of a plan again today and a plan for the future. Typically, when it comes to how much of your income you should be setting aside for housing, it's really difficult for me to say. Again, there's lots of situations, like if you are that person starting their career and you're going to have continuing growth to your income, or if you are a couple that's going to have some reductions in the income because of time off of work, job changes to accommodate for childcare or expenses to cover things like that. It's hard to put it in perspective, but typically the suggestions that you see is anywhere around 30% of your income going towards the housing payment, whether that's owning or renting. And I think that's, a pretty good idea, a good spot to be in if you can keep your housing payment around that. It's going to be pretty helpful for you. Now, a lot of times, you might have to go up a little bit higher based on where you are looking to buy. If you're in the higher cost market, perhaps you have to be somewhere closer to 30, 35, 40%. But just understand you got to make that payment and be comfortable with that, which means you might have to make some sacrifices elsewhere. But making sure you got your budget established is step one by a mile. Make sure you do that. Again, there's some great worksheets. If you want me to send you some of those worksheets, just go ahead and message me and I'll go ahead and shoot one over to you. The next thing you want to do is get your credit report pulled. And I did a whole video on this. I'll link it in the description, after this live stream. You can check that out, but it kind of gives you step-by-step instructions about how you are entitled to your credit report, how to go about getting a copy of your credit report, and what to do when you get it. But before you talk to a lender, you do that budget worksheet, and then you can check your own credit. You are entitled to a free credit report, and you want to look for errors, things that are incorrect, and try to get those fixed prior to getting the credit report pulled by a bank or lender. And, if you do have a relationship with someone who can review the credit report, there's some great tools and things you can use that will analyze your credit report and give you ideas how to improve it. And when you do apply and get pre-approved, you're typically not writing anything in stone. So your lender can always, tell you where you are with your current credit score and help give you that guidance to get your score up. Once you go and lock in the rate, that's really when the credit score really matters. And it does make a huge difference when it comes to the products that are available to you and your terms. The higher your credit score, the more options that are available to you and the better terms you're going to get. But go ahead and check your credit and review it and get any of those errors fixed. Next thing you want to do is start saving. There's a couple different ways that you can do this. Again, you do have some options when you are purchasing your first home, depending on where you are, that can take advantage of some great products and grants. But there are closing costs, and depending on where you're buying, those closing costs can be anywhere from 2.5% to 4% of the purchase price. And you could be in a market that's really competitive where you have to come out of pocket to cover those costs. Even though you're doing 100% financing product that's available to you or getting advantage of a grant or down payment assistance, you might have to cover some or all of those closing costs. In addition to that, there is more than just the down payment and closing costs when it comes to purchasing a home. There's some maintenance costs and things that you have to start being responsible for when you own the home. When you're renting, there's probably a certain limit of repairs and maintenance that's needed. It could be a $50 to $100 where your landlord is just going to leave it to you to make those small fixes to the place you're renting. But if there's a big item, you just pick up the phone and you call your landlord or you call the building that you're renting in, and they will take care of those items and repairs for you. Whereas owning, that's your responsibility. You've got to fix those things. And in some cases, you can't, leave those maintenance repairs off. You got to take care of them right away because it could get worse and it could cause, either bigger or more expensive problems for you down the road. But having the savings, having that cushion, not only is going to help you if you need to cover some of the closing costs, it's also going to help you after closing. And what's great, it's you are in a competitive situation and you are in that first-time home buyer market. There's going to be probably some competition out there, and if you're going in and they're asking for seller help to cover your closing costs and you're not, that's going to put you in a better spot to outmaneuver, out-negotiate your competition. So be prepared, have some sort of savings, whether it's $1,000 or $10,000, whatever you can save, start saving. And then you want to find a mortgage lender. Again, we kind of talked about the market and there being a mortgage banker, a mortgage broker, a bank, and a credit union. And again, we're all doing the same thing. So there's some kind of guidelines that you see here for finding a local lender. Now, you can have a loan officer that is in your area, but their company is not in your area, meaning they might have a branch, but they might have their headquarters somewhere in Texas, California, or out of the market. Whereas a local loan officer that works for a local company um, has their headquarters in that area or close to it, they might have some additional products and benefits that you can take advantage of through state bond programs and things. So I've been a lender for over 20 years. I've worked for national companies, some in the top 5 in the nation, to now where I am working with a truly local lender. And I always used to say that I'm a local loan officer throughout my entire career. But it wasn't until recently where I realized that was really never the case. While I was local, the company I worked for were not. And so I wasn't able to access a lot of these down payment assistance programs and things that other lenders may have. But now, where I am, there's a lot more opportunities and programs that I can use to assist some first-time home buyers. So there's a few questions and things that you can ask to make sure that they have access to programs that you could benefit from. But it's really important the loan officer you choose is ultimately going to drive your experience and can really have an impact on if you're going to be successful in a competitive market or not. So make sure you go through, the guidance that, I have up on the screen. Ask for recommendations for people. I would really refrain from just going on to a social media site and putting in a blind comment that, hey, does anyone know anyone? Because you really can open yourself up to a can of worms there. But if you know someone who purchased a home recently, you can ask them. Your Google reviews is a great place, Yelp, things like that. Read the reviews, do the research, and have conversations. Interview and shop around. Find the loan officer that's going to be able to serve you best. And then once you have that relationship and you kind of start getting an idea, you've got your budget done, your credit checked, you've started to establish relationships with professionals you're going to be working with, you really start to need to narrow in on the area that you're looking to purchase. And why does this matter? Well, there's different loan limits, there's different income limits for particular products and things like that. So you want to have an idea when you are speaking with the loan officer where you want to purchase, because again, being a local lender, I can tell you that some counties have something called spark funds, which can be used to buy down your interest rate. Some have down payment assistance programs that you can take advantage of. So having an idea is going to be helpful, so that loan officer can communicate those opportunities and those programs for you. If you're just saying, hey, I'm looking to buy anywhere, and where I am, right outside of DC, we've got Maryland, DC, and Virginia, all within about a 30-minute drive. So if I have someone who's looking in Northern Virginia and then all of a sudden they cross over to Maryland, that is completely different products, grants, and programs that they take advantage of. And while that's perfectly fine and it does happen, it changes the conversation. So if you're open to all the different markets in your state, different counties, different cities, make sure you communicate and say, hey, these are the ones I'm looking for, so that loan officer can then look for particular products and programs that are going to serve you best in those areas. And then you want to know what kind of property you're purchasing. And this is kind of important. Hey, again, no one knows exactly what home they're going to buy when they first are starting off. I started this process when I purchased my first home, probably looking for a condo, ended up with a townhouse. And so you can adapt, but having an idea, hey, I'm looking, open to condos, townhomes, things that have condo dues or HOA dues. There's things that we need to budget for and plan for when you're looking at those properties. Whereas if you're buying a single family home, perhaps there's no HOA fee or a very low HOA fee that can kind of change your approvals. And also the products, the down payments, things like that, depending on the type of property you're purchasing, can be different. But there's really, really important you have an idea of where you want to buy and what types of properties you're interested in. From there, you can find a real estate agent. Real estate is local. Well, there's some great agents who serve big markets, but then if you are in a competitive situation working with a real estate agent who's highly specialized in that particular market or that particular type of property that you're looking for, might be very helpful for you to go and work with them. Again, people may know a lot of real estate agents. I would refrain from going on to social media sites and just typing a blind comment, asking recommendations, but asking people who've recently purchased a home or sold a home, asking about their experience, getting recommendations, and then going online, looking for reviews and feedback from those. At the end of the day, the real estate agent you work with is probably the most important person. They're going to be holding your hand throughout this entire process, right? From the dream of home ownership to achieving the dream, to helping you years down the road, manage it as a rental property or sell the property. When it comes to the financing, we're just there for a small portion of the transaction. And while it's really important because you'll be making that monthly payment, and that strategy can have a real impact on your ability to get the home and maintain the mortgage. The real estate agent really is the one that holds your hand and is your guide throughout this process. So it's really important that you go through the process and find the best agent possible. So there's some information that you can see up here about how to do that. And more on that later. Okay. So plan for flexibility. I've learned this, every month more and more, especially in a market like today where, there is kind of the tale of two markets. They call it like the K economy. There's markets and neighborhoods that things are, booming, still really competitive. And then there's some markets and some price ranges that it is not the case. It is, buyers have an advantage and they can take advantage of. So you've got to plan for the flexibility. You've got to have, the more flexible you are, I think the better your chances of having a successful transaction and a good transaction. And flexibility could be things like your timing, giving yourself plenty of time to find the right home. And, buying the wrong home is going to cost you a lot more than you think because it's more expensive to sell a home than it is to purchase a home. So you really want to be mindful of that and give yourself plenty of opportunity to go out and search for the home and negotiate terms that work for you. But again, it doesn't always work out perfectly. Sometimes you might have to cover some of the closing costs a little bit. Sometimes there are some repairs that need to get done. Sometimes the seller will pay for those and do those before closing. Everything is negotiable in a real estate transaction, and the more flexible you are, the better. But again, as long as you know your budget and you stick to that, you'll probably be fine. And don't settle. Buy the house that works best for you. And there can be pitfalls. It's possible and it happens. Of course. Things can pop up on your credit during this process. You can have guidelines change, or products are no longer available that you were planning on using. It can be pretty painful and make the process not as fun and ultimately not even be successful. So a couple things you need to look out for: those negative items on your credit. Protect your credit. Don't co-sign for anything or anyone if you are thinking and hoping to buy a home. Don't apply for new credit. That really can kill a deal. Don't make changes to your employment. Don't change jobs unless you communicate and discuss that with the loan officer first. Obviously, we're not trying to have you stay at your same job if there's a great opportunity, but sometimes and you can change jobs and it really doesn't have any impact. But have that conversation with them. Don't think that job change doesn't really matter because you still got a paycheck or you're still employed, because there could be a portion of your income that we can't use anymore, or perhaps you're changing industries and we can't use your income at all. Like, your employment history matters, all of that. So just make sure you communicate that with your loan officer. And this is one that I've seen time and time again, and that's keeping track of your deposits. Now, when you're purchasing your first home, you might be one of the fortunate people to get some help from some family or friends. You might be looking to sell some things, on Marketplace, and you've come into some cash or getting some funds from various sources. And then while that's okay, there are some acceptable and not acceptable sources of funds that can be used to purchase a home. A real estate transaction, getting a mortgage, is a financial transaction. So one thing that we have to do, all the funds that are being used to purchase the home, we have to track. We have to know what those sources are to make sure that they are acceptable legal sources. So as you're making these deposits, just take note of what it is. If you got a check, take a picture of the check. Keep track of it, because we may ask about these deposits when we see your bank statements. And knowing what those are, being able to provide documentation, explanations, is really going to help make the process a little bit easier for you. And then again, have that relationship with your loan officer where if there are changes to the loan guidelines, programs for the better or worse, that they're communicating that quickly and clearly to you. Okay. Um, so with that being said, we're going to jump into some mortgage programs and kind of talk about that. I don't see anyone watching right now. I don't see any comments, so I'll just continue on full steam ahead here and talk about these different products. And so, again, when you're purchasing a home, you're getting a mortgage. Think of it like you're getting a vehicle, right? The difference is when you're buying a car, you've been on the road driving around basically your whole life. You know what kind of cars are available. You see TV commercials. They're in your face all the time about the different cars and the different vehicles that you can get. So when you go to buy a car, you have an idea of like, this is the kind of car I want. A sedan, an SUV, convertible, a truck, whatever. Well, when you're getting a mortgage, all of that's kind of hidden. No one walks around and says, like, this house I use conventional financing, or this product I use FHA. So it's not really as well known. So before we kind of get into some numbers, let's just kind of do a brief overview about these different products. Again, if you're watching this, you can pause to kind of read through this in more detail. I just want to talk about conventional financing for a brief moment. This is a very common loan product. It's really for anybody who's purchasing a home, whether it's a primary residence, an investment property, any residential property. The most common form of a mortgage is a conventional loan. Fannie Mae and Freddie Mac both offer these products. They allow for a minimum of 3% down for first-time home buyers, up to the max conforming loan limit. You can put down 5% and go a little bit higher. Like we're in a high-cost market here in the DC metro area. These loan limits, I've just noticed, I forgot to change them. Those are from 2025. They went up a little bit this year, and but not by too much. So I'll update that and put that in the comments here. But the better your credit score is, the better the terms are going to be. Really important here. Your debt to income ratio, which is something that we calculate, can typically max out around 50%. So that's your total debt to income ratio. You have to get mortgage insurance if you put down 20%. There are sometimes some marketing gimmicks and schemes out there that say, hey, we got a product with no MI, 10% down or whatever it might be. Just know it's probably baked into the rate. There's no free lunch, okay? You can probably bank on some cost somewhere in that loan that is basically replacing the cost of the mortgage insurance. But if you put down 20% or less than 20%, sorry, then there's going to be some form of insurance, some additional costs that you're going to pay on these conventional loans. You can use gift loans. You can have non-occupant co-borrowers. You can negotiate with the seller to have them cover your closing costs. You'll just be responsible for any down payment. Then you have FHA financing. FHA financing is not just for first-time home buyers. You can be purchasing your second, third, or fourth home and use an FHA loan. Really, why you start to see people use FHA versus conventional is because of their credit score. This is a government loan that's created through by Ginnie Mae, by HUD, and basically they just see everyone as equal. So it doesn't matter how good your credit score is, you're getting the same terms, the same mortgage insurance costs as everyone else using FHA financing. Whereas if you went with conventional financing, there's tiers. The better credit scores you are, they're giving you premium in improvements on your terms, your rates, your points, your mortgage insurance. Whereas FHA, everyone's getting the same. So you start to see people use FHA. It can be, kind of vary just depending on interest rates and what's going on in the market. But usually if you're below a 700 credit score, FHA starts to be a little bit competitive with conventional financing, meaning that you've got a lower monthly payment. The thing you have to watch out for is there's an upfront cost of 1.75%. This can be financed, rolled into your loan, which is what 99.9% of people do. Just understand, when you go to sell the property, you're basically going to have, a 1.75% higher payoff than you would have if you went with a conventional loan. It's just that fee that you're going to be paying. And also there's monthly paid mortgage insurance. And with conventional mortgage insurance, that will ultimately stop. With FHA, it is going to be paid for the life of the loan unless you put down 10%. But it does allow for non-occupant co-borrowers. It does allow for gifts. It does allow for seller concessions. And a big difference is this loan is assumable. So if you have someone who got an FHA loan, in 2020, 2023, they might have a really good rate. And you can go in and purchase that property and take over the existing mortgage. So I did a whole video on that in the past. Happy to answer the questions about that and assumptions if you want to. VA is for veterans, so these are only available for people who qualify, who are serving in the military, and they've received their eligibility, or those who have are no longer active duty. They are out of the military, they're retired, they're veterans. They can use that. It can also be used in some cases if you have a spouse, who the veteran passed away. They might be able to take advantage and use their entitlement. It's a great product. Definitely, it's one that I would say is used often for those that do qualify. You can always, and we'll talk about this later on, do a side-by-side comparison. But usually VA is going to be the better choice. There's just a couple things you have to kind of look out for. Number one, it does allow for 100% financing, which is great. It just depends on the entitlement and whether or not you have to put down a home. There is a funding fee that you're required to pay with this, and you could potentially be exempt from it depending on your percentage of your disability. The funding fee is just like the FHA. It can be financed. Most people do finance it. But again, when you go to pay off the home, you're just going to have a slightly higher payoff than you would have if you went with a standard conventional loan. You can get the seller to pay for the closing costs. You can, also assume this loan. There's a lot of people that have been trying to assume VA loans, that were taken out a couple of years ago, and they got some great interest rates on those, so they can be assumed. The downside here is with VA, it does not allow for non-occupant co-borrowers, and you can use gifts if you need to. But it is certainly a great product and one that I would highly recommend you look into if you are entitled to it, and compare that to your other options. There's also USDA. So here in Northern Virginia, we do, if you start going a little bit further away from the city, you might be eligible to take advantage of a product called USDA. And this is very similar to FHA financing, except that it doesn't have a down payment. It's a 100% financing program. There's an upfront mortgage insurance cost and a monthly mortgage insurance cost, and the monthly is required for the life of the loan. It's a great product. I would highly recommend you look into this if you are starting to go a little bit further away from some areas, depending on where you are. You can type in the property address and see if it's eligible for USDA financing or not. And again, it's a very similar product to FHA. It's just offers the 100% financing in certain areas. And then if you are, looking at a higher cost market, or you're looking in certain areas, rather, this slide is about the local and state bond options. So every state typically has a housing agency, an agency that will take those products that we just kind of went over and create their own version of them and add some incentives and benefits to them to help first-time home buyers or move-up buyers in that market. And they can be state-level ones. There can also be some county and city levels products. But you can typically get a conventional FHA or VA loan through the state housing agency. So here in Virginia, my home state, you've got Virginia Housing, which offers products called a Plus program, which is you can do 100% financing conventional loan or FHA loan. There's also down payment assistance grants that you can take advantage of, and you just get that loan product through Virginia Housing. Just like, again, the car dealership, they're not they're originating, they're creating the products, they're not selling them. So you've got to go to the local lender, the local mortgage dealership, and get that Virginia Housing mortgage through them. But we certainly look at these products when we're dealing with first-time home buyers that are looking in Maryland, D.C., and Virginia to take advantage of it. And special, if you're watching this now, in 2 weeks, I'm going to do another live session. Two Tuesdays from now, that is specifically only about the down payment assistance programs and grants. So it's a deeper dive into this. You can go to HUD.gov/states and select your state and get some more information about the housing agency that is in your market and what products they have available to you. But I'll go into more details about those in 2 weeks, so be sure to kind of check that out. But now they kind of got a brief overview about the different loan products. What ends up happening is, again, when you work with a local lender, We're gathering your information, taking your application, and pulling your credit report, and we're relaying what products are available to you and putting together different scenarios to show an outline of what the costs are going to be for those products, um, from the closing costs to what you can expect for your monthly payment, and trying to educate you about your different products. Now, we're not the ones that make the mortgage payments, and so a good loan officer is going to educate you. They're going to show you the different options that are available to you, and you're the one that's going to choose the mortgage that's best for you at the end of the day. Um, and it's important that you choose the one that is right for you and ask questions. Hey, tell me more about conventional financing. Tell me more about FHA financing, so you can get more comfortable with the pros and cons for each product. Now, there are pros and cons for every product. Again, there's no free lunch. You'll just find based on where you are today. And again, we talked about the budgets in the beginning of this live session, your future budget, to figure out which one is the most comfortable for you. Okay. If you went with the FHA financing, you've got that mortgage insurance for life. Perhaps you're going to be trying to refinance it down the road. Whereas conventional loan, perhaps you have this extra income, you can put more towards the loan, and get that mortgage insurance removed early and not have to refinance. So a lot of different strategies and conversations you can ask, but tell me more about this. That is a question you should be asking as much as possible. But once you get pre-approved, that's really when you're going to start hitting the ground with a real estate agent, looking at properties. You got to make sure you avoid those pitfalls. Life happens. Don't be a stranger. Communicate those. Communicate your questions or concerns, and prepare for things that we need to do from the financing aspect, which we'll talk about here: the appraisal, getting a condo, locking in your interest rate, and then follow the financing process, which we'll jump into here shortly. Okay, so I'm not going to spend too much time about this. I've kind of talked about it already, but I've seen some people think they can go through this process without a real estate agent. There's been some changes over the last few years about how buyer agents are paid. And yes, make no mistake about it, you are paying the buyer's agent, whether the seller's going to write them the check at closing or you're going to write them the check at closing. The buyer agent you are working with, you are paying for their service, okay? Just different ways that you're going to pay for it. So really hone in on finding the best agent for you. It is a business transaction, okay? You might have a friend or family member that's a real estate agent, but maybe they're not a good one. Don't use them. Find a good agent that makes the best sense for you, and meet with them. They will help you establish your timelines. They will help you determine the best location. I grew up in this area, and I've lived here for over 30 years, and I'm still discovering new neighborhoods that I had no idea of. Real estate agents are out driving the market and looking at the market all the time. They know about different areas and different house types, prices that you don't know, even though you might live and work in the area that you're looking to buy. So find the local expert that can help guide you through that. They can also understand the market conditions. The market shifts, it changes. We had a couple of years where it was just such a crazy busy market. It didn't really matter what time you went to put your house on the market. It was going to sell fast. It didn't matter what time you wanted to purchase the home. You were going to be competing against 5 to 20 other people. Whereas we're starting to see some seasonality. So they can advise you about, hey, this is kind of a good time to be looking for properties, a good time to get your house on the market. Whatever guidance you need as far as the market conditions, they're the ones that are the best to provide it to you. And they'll handle all the negotiations. They'll handle all the paperwork for you. But again, don't be afraid to ask questions. Make sure you've got that kind of relationship with your agent, because it's a big check, that they're paying for, but they are worth every cent of it when you find the right agent. And then again, paying for expenses. We talked about this a couple times, and I just keep wanting to kind of mention it. Even if you use 100% financing, there are costs. Okay, you're going to have closing costs. You're going to have costs of moving into the property. You're going to have costs of maintaining it. You're going to have utility costs. You're going to have costs for buying furniture. So save, and plan for these expenses. When it comes to getting the mortgage, the only thing that we require typically to be paid by the borrower up front is going to be the appraisal fee. And that appraisal fee, which we'll talk about here in a moment, is a couple $100. You can negotiate to have the seller cover your closing costs, your prepaids and escrows. but you will be responsible for any kind of down payment. Has to come from you. It can, of course, as you talk about, be a gift. And so make sure you talk to your loan officer about the gift process and what that looks like. Okay. But plan for those expenses before, during, and after buying a home. And again, avoid the pitfalls. These are the same pitfalls. It's just they're always there. And when you're working with a local guide, your lender, your real estate agent, we are doing our best to help you navigate and avoid those pitfalls as well. But it is a two-way street. Not only do we have to communicate, but you have to communicate to us and keep us up in the loop on your situation. And again, flexibility is incredibly important. So I just kind of wanted to mention that. So as far as the application goes, it's all the same no matter who you talk to. We're all going to be asking the same questions, getting the same application completed. It's a universal form, basically where you've lived and worked for the past 2 years, how much money you make and you have in the bank. And then from there, again, all the different loan products that we have access to, we'll start to share those with you. Now, some lenders have access to different products and some don't. One thing that we do, if you're using conventional financing, is you get run through an automated underwriting software program that will determine if you need an appraisal or not. And if you do need an appraisal, which is probably very likely that you're going to have to get an appraisal done, think of it, again, back to the car analogy. It's like checking the value of the car that you're buying, checking the value of the home on Kelley Blue Book. An appraiser is going to go to the property. They're going to have a copy of the contract that you wrote with the seller, and they're going to be making sure that the value is supported. Looking for comparable properties and comparing like the size and location of the home to those comparable properties and making adjustments, for things like the condition. And at the end of the day, they're going to verify if your value is supported or not. So it's really important that you kind of understand that an appraisal report is not like a home inspection, but just like your home inspection, which the agent will talk to you about, it's a check that you got to write prior to the closing because the appraiser and the home inspector did their job well in advance of closing, and they did their job whether you end up closing on that home or not. So they typically are going to require the appraisal and the home inspection fee up front. Now, it's important to note too when it comes to the mortgage is based off of the lesser of the appraised value or the purchase price. Okay. So it doesn't matter if the home appraises for more than what you agreed in the seller to sell it for. We're going to be basing the loan terms off of the lesser of, so the sales contract. While it's nice, you got instant equity and it's a great feeling, it doesn't really change any of the circumstances or the loan terms that you're getting. So just because your house appraised for higher doesn't mean that your mortgage insurance is going to get removed or you're going to get better terms. Again, everything's going to be based off that lesser of the appraised value or the purchase price. And if you're buying a condo, typically a condo is going to require a condo questionnaire to be completed. And I will just kind of say, this is kind of something that's come up recently this year. And again, 20 years in the industry, but I'm seeing it more and more. Some condos are not financeable through your traditional products. Their condo association had made decisions to change the bylaws of the condo association, and it's no longer approved by Fannie Mae or Freddie Mac. If that's the case, you've got to go with a product that offers what they call like a non-warrantable condo, and it's different loan terms, different down payments, things like that. And while it is painful and it's upsetting, just understand that Fannie Mae and Freddie Mac are asking these questions and doing these due diligence, looking into the condo, ultimately to protect you. Okay, it could be things like the condo association decided to stop contributing to the reserves of the condo. And down the road, if you're living in this property, years and years later, perhaps the condo needs some major maintenance done and the condo is short of reserves. So then they have to go to all the owners and they send them a bill for, quite a lot of money to cover the cost for the repairs and the maintenance that's needed. There could be, various reasons, but if you are buying a condo, not only do you have to qualify for the condo, but the condo also has to qualify for the financing program you're looking at too. And we are seeing more condos fall out and no longer be approved for those particular financing products, Fannie, Freddie, FHA. So once you've got that contract, that's also a great time where you can lock in your interest rate. There are some lenders out there that offer things called lock and shop programs. We do. A lot of the companies I worked for in my career have offered that. Honestly, that doesn't get utilized very much. Um, uh, but once you have a ratified contract, that's typically the time that you can lock in. The lock and shop product is great if you're in an environment where rates are skyrocketing. They're moving up really quickly. So a couple of years ago, we were in that situation where we saw interest rates rising from 3-4% to 6%, and so we had a lot of people who were actively looking. And rather than sit on our hands and watch rates go up, we took advantage of our lock and shop programs, locked their interest rate in while they shop around for the house. In this case, where we kind of see mortgage rates kind of holding steady, it's not really recommended, at least in my opinion, but it's a thing that we monitor, and most loan officers are going to monitor daily. So if they're in a situation where rates start to go up and it seems like this is just going to continue, perhaps that's something that we can look into do for you. But when you have a ratified contract, we can typically lock in the interest rate because at the end of the day, the collateral of the loan is the interest rate. That is what we are locking in, that property address. So what it means, locking in stops your rate from going up. Okay, if you're comfortable and you're happy with the payment, lock in the rate because rates will rise like a rocket and fall like a feather. And I did a whole video about this on my YouTube channel. You can check out. I'll link it in the description as well. About how volatile the market can be, especially now, where headlines can really move markets. And so if you are satisfied, locking in makes a lot of sense because that stops it from getting better. One thing that you want to ask your loan officer is, do they have a rate renegotiation or float down option? Most lenders do, but you want to make sure you get this in writing and get their parameters of how it particularly works. But locking in stops it from going up. But if rates improve while you're going through the process of purchasing this house, getting the mortgage, perhaps they can lower your interest rate, renegotiate your interest rate for you, so that when you go to closing, you get the lower rate. Typically, lenders do this because they rather renegotiate the rate with the consumer than have them walk out the door and just go down the street to get the loan with somebody else. So a lot of people do. It's just everyone's version of their float down option or the rate renegotiation is going to be slightly different. Again, you're all getting the same mortgage. It's a commodity. Your service, the experience you get is what's going to be different going from one lender to the next. So ask the question and make sure that you're comfortable with the answer and happy with it. But definitely, it makes all the sense in the world if you are happy to lock in the rate. And this slide got really shrunk down, so I apologize. We can zoom it. Just kind of walks through the financial process. I'll just kind of quickly go through it. Determine if you're ready to buy a home. We kind of talked about that earlier. Look at your budget, look at your credit. Then go ahead and complete an application and get pre-qualified. Pre-qualification means you complete your application, but the lender is still missing some documentation. They should be able to provide you some preliminary financing scenarios, financing options, looking at conventional versus FHA versus USDA versus any state or bond programs they have access to. And then once you're comfortable and you know those numbers, start house hunting with a real estate agent. At the same time, get updated financing options. From the lender, rates change. There's a lot of volatility. New products become available. Grants become available. Then they run out of funds. So just stay in contact with them. Typically, what we always advise clients to do is when they're going out looking at properties in the weekend, if there's one that they're interested in, send us a listing. But always just send your top one or two properties every time you go out, just to kind of get an idea of where numbers are and what products are available. As you start narrowing in on your search and your timeline starts getting close to the end, you want to start making sure you get your documentation into your loan officer. We always ask for the documentation right when we get the application. We always try to jump straight from the pre-qualification to the pre-approval because a lot of times the documents might tell a different story than the application. And after 20 years in the business, I've just learned it's better to be thorough and diligent up front than be surprised and have some upsetting news down the road. So we're always trying to get the documentation early on, and that's a pre-approval. That letter carries a lot more weight in the market than just your generic pre-qualification. And then you can identify the property. You start, getting the disclosures and the loan going into processing and underwriting. So we'll kind of just walk through quickly here some different loan products. This is kind of how we help clients compare these different options. We use software that allows them to see kind of a side-by-side comparison to help them determine which mortgage product, which vehicle is the best vehicle for them. We're educators and advisors. We're not trying to sell anything, and most loan officers are like this. And if they're not showing you a lot of options, that's a red flag. Maybe you need to talk to somebody else. But before we do that, let's just kind of set the stage. We're looking at all these options as assuming the same person. If you know someone who used a product, they might have a different credit score than you, or they might have different incomes or job histories, whatever. Their situation is different. So just understand everyone's terms, everyone's numbers might be slightly different. But in this case, let's just assume it's a person who is a first-time home buyer. They were paying $3,300 a month in rent, and they've got great credit, over 740. They make $95,000 a year and very minimal debt, but $50,000 saved. Okay. So the first thing that we look at is conventional financing. We're looking at comparing that to rent versus purchasing a property for $525,000. So you can see here that even though their net monthly payment is higher after the tax savings comes in, then they potentially are paying very close to what they'd be paying in rent. I'm not a CPA. You want to talk to your accountant about what actually, if you have any tax benefits when it comes to home ownership. In order to take advantage of the tax benefits, you have to itemize your taxes. But that's certainly something that we always like to point out to first-time home buyers. If they are itemizing their taxes, they can possibly find a home and have their net payment be pretty close or similar to what they've been paying in rent. Okay. But assuming that they didn't get any help from the seller, you can see the cash to close looks like just over $30,000. And conventional financing offers that 3% down product for first-time home buyers. But just like we talked about, if you're owning a home, you're building your net worth by paying down your loan balance. So if you fast forward 7 years down the road and the home appreciated 3% a year, you can see the estimated net worth is substantially higher for someone who owned a home than it is someone who rented and just kept that money in a savings account earning 4%. Okay. In my experience, there's no quicker way to build your net worth than through real estate. Okay. There's obviously some great investments. This market is, again, been, the K economy. Some people are doing really well in the market and some people aren't. But in my experience over my 20-year career, real estate has been the best investment, hands down. It's just about finding the right mortgage product and making sure that investment doesn't become a nightmare, helping you manage it. So in this case, we might see a borrower who has a little bit more funds that they could use. So we show them a 5% down option so they can compare it to a 3% down option. Say, hey, if you put down a little bit more, if we take your cash to close to just over $40,000, your monthly payment goes up slightly, okay, but not as much as the 3% down option. When you borrow less, you pay less. It's just math at the end of the day. What's nice about this is because they put down 5%, they also drop in the mortgage insurance tier. So they're getting better terms when it comes to their mortgage insurance. Now, same thing, you can kind of run these numbers for you over time and see what makes the most sense. Continue to rent for $3,300 a month or buy this property and earn some appreciation. And we can compare that to an FHA financing. Even though this person had great credit, it's still our job to lay out the different options so they can choose the one that's best for them. FHA is great, 3.5% down. It's got the usually competitive interest rates compared to conventional. So you'll notice the interest rate is going to be a little bit better than the conventional options. And then we've got slightly higher cash to close compared to the 3% down conventional option because of that 0.5%. In this case, that they're financing that funding fee, so you'll notice the loan amount is a little bit higher. So FHA is great. Still, if you compare the net worth over time, you're better off in this analysis comparing owning compared to renting. And then if they are eligible, VA financing usually comes out to be the best option, hands down. It allows for 100% financing. It's got great interest rates. There is a funding fee that they may have to pay, 2.15% as of today for first-time use. But it's a great option. You can see the cash to close is the lowest we've seen so far because they're not putting anything down. They're just covering the closing costs. And then you have USDA financing. So this is very similar to FHA. It's got the upfront mortgage insurance and monthly pay mortgage insurance that's required for life. but there's no down payment. So you'll notice that the cash to close is just covering the closing costs here. Interest rate is still great compared to conventional options. At least in today's environment, you're getting a good rate. So where you are in the spectrum of these different products, again, you may not be able to use VA because you're not a veteran or active duty. Okay, so don't look at that option. You're not buying in a rural area. USDA financing is not available to you, so we don't even look at those options. But at the end of the day, what you want to do is kind of compare these side by side. Either you or your loan officer can put together a grid kind of looking at these different products, so you can kind of lay them out and figure out which option makes the most sense for you. Now, when you're getting pre-approved, you're getting pre-approved for all of these options, right? You've got your application. It doesn't matter what product you use. It's the same application. It's the same credit report. So when you go out to look at properties, you can decide which product makes the most sense for you. Like perhaps you have a home that is perfect. It's cookie cutter. You don't have to do anything when you move in. So you want to go with the 5% down option, put that extra $10,000 to use, and get the home, have a slightly better monthly payment. Or perhaps you have a house that needs some TLC, or you don't want to completely liquidate yourself and you want to have that $10,000 cushion. You can go with the 3% down option. Or perhaps your credit score isn't as great as it is in our example borrower, so these numbers are kind of skewed more towards you using FHA financing over conventional. Again, we don't know what vehicle you are going to use. You don't know what vehicle you're going to use. A mortgage is that vehicle that's going to get you to the home. You need to explore all of your options. And the purpose of this live stream was just to kind of go over those different options. So can bring it all together, establish that household budget today, and get an idea of what you think your budget is going to be for in the future. If you need access to a budget worksheet that I shared with you earlier, let me know. It is a simple Google search, Freddie Mac budget worksheet, consumer financial protection budget worksheet, or just type in household budget worksheet. I'm sure there's lots that will come up. But sit down, really take your time to get that budget ironed out, and then schedule a buyer consultation and get qualified, pre-approved. During the consultation, that's kind of your interview, a short conversation with the loan officer to make sure that they're the right fit. Do they have the right products? If you're a first-time home buyer looking to take advantage of certain products offered through your state or county, which we'll talk about in 2 weeks on our next live stream in more detail, ask those questions. And don't be afraid to ask questions. They're here to serve you, okay? And then you want to start getting the application in, getting not just pre-qualified, that's great, but get your documentation in. That's highly recommended. And then start to review those options with the loan officer and start looking at properties in person. Anytime you come across a property you're interested in, go ahead and send that over to the loan officer, and they will send updated scenarios for you with current interest rates. It's really important in today's market that you are staying in great contact with your loan officer to make sure that any of the volatility is being communicated with you, any of the changes into the products are being communicated with you. And I hope this was very helpful. We're coming in right at an hour, which is great. I don't see any questions, any comments. Again, if you're watching this in the replay, go ahead and drop them in, and we'll monitor these for the next couple weeks and respond quickly and timely. But thanks again, and be sure to check out our next live stream in 2 weeks and our channel for all other helpful videos. And I hope all is well, and you guys enjoy this beautiful Tuesday.